financial instrument presentation. Okay. Now, so we are looking at compound financial instruments. So in compound financial instruments, we learned that to deal with it, you first have to split between liability and equity what component. We said that this instrument gives the holder all the two rights. The holder can either go for cash or to convert the instrument into ordinary shares. The right given to the holder to receive cash or to redeem by cash is what we call the liability portion. And the right given to the holder to convert the instrument into shares is what we call the equity portion. The technical name is option to convert. Then we learned that to split between the liability and equity portion, it is the face value that we are splitting. So you first calculate the liability portion, then after that you deduct it from the face value to get the equity portion. How do we then calculate the liability portion? We learned that to calculate the liability portion, it is the present value of all the remaining future cash flows to be paid to the holder. So we find the present value of all the cash flows that will be paid to the holder. And the cash flows are in two forms, or we have two categories of cash flows. That's the interest payments that will be paid over the specific period. And then the redemption value, that is the amount that will be paid at the end of the period. So we find the present value. That's what we looked at. Then after finding after you first estimate these cash flows, then you discount using the effective interest rate. Then you get the present value, which is the liability portion. Now we also learned that when we talk of the effective interest rate, it is the rate applicable to a similar instrument without what? Without a conversion right. Or it is the rate at which NPV is equal to 0, which means that it's also the same as IRR, the internal rate of what? Return. So if the effective rate of interest is not given, then you would have to use the interpolation method, the IRR method, to determine the effective interest rate. Now, we now want to look at where there is issue cost. Where there is issue cost. It's not difficult. So where there is issue cost, two effective interest rates will be given. Whenever there is compound financial instrument with issue cost, two effective interest rates will be given. Two effective interest rates would be given. And the two effective interest rates, we have one that has the effect of the issue cost and one that has no effect of the issue cost. These are the two effective interest rates. So we have the effective interest rate with the effect of the issue cost. It means that such effective interest rate has taken care of the issue cost. The issue cost has been reflected in ascertain the effective interest rate. Then we have the effective interest rate without the effect of issue cost. So let me change this. I want the without to come first because of what I'm coming to write. Without the effect of issue cost. Then effective interest rate with the effect of issue cost. Now, the effective interest rate without the effect of issue cost, it has a purpose. What are you going to use? What are you going to use for? That is the effective interest rate that you must use to split between the liability and what equity portion. So you split between the liability and equity portion, that's the face value as it is. You split between the liability and equity portion the normal way. But this time, the effective rate of interest you use should be the one without the effect of what? The issue cost. This should be used when splitting between the liability and equity portion. Then, what will be the use of the effective interest rate with the effect of the issue cost? So now, we are going to go through a process. In that process, after we have split the liability and what? Equity portion, we now deduct the issue cost. How do we deduct? We set the issue cost in the ratio of the liability portion and equity portion. Then we deduct. So we are going to get a revised liability portion and a revised equity portion. And you know the liability portion should be measured at amortized cost. So because we have deducted the issue cost, when we are amortizing, we need to use the effective interest rate with the effect of what? The issue cost. Did you understand? I'll write everything for you, so you just relax. The first thing we want to learn is what is the purpose of the two effective interest rates that is given in the question. The one without the effect of the issue cost, the only purpose is that you should use it to split between the liability and equity portion. That is when you are splitting between the liability and equity portion, we discount the cash flows. In discounting the cash flows, that's the effective interest rate to use. The discount factor to use should be the effective interest rate without the effect of the issue cost. Did you understand the first part?
Yes.
Yeah,
Yeah,
yes.
it's clear.
So let me write the second one. Then, if you have any question on the purpose of the two effective interest, you let me know. So this should be used only for the liability at amortized cost. Liability at what? At amortized cost. In other words, it should be used during amortization. It should be used for amortization. For amortization. So that's the purpose of the two effective interest rates. Now, what is the process? The process for accounting for compound financial instrument with issue cost, the steps. The steps. How to deal with compound financial instrument with issue costs. What we did the last time was without issue costs. This is with issue costs. With issue costs. By the way, do you have any question? Okay. With issue costs. Please let's go through the steps. Let's go through the steps. Step one. Step one. Step one. So step one, what do we do? We look at the split. So we split the liability and equity portion using the effective interest rate. Using the effective interest rate without the effect of issue cost. Without the effect of issue cost. That is the effective interest rate that has not taken care of what, or that has not reflected issue cost. Then after that, the issue cost, step two. This is step one. Step two. Share the issue cost. Share the issue cost in the ratio of the liability and equity portion. Liability and equity portion. And deduct respectively. So after you have said, you deduct each of the issue costs from the liability and the equity portion and deduct respectively. To arrive at, so when you deduct, you are going to arrive at the revised liability portion. The revised liability portion and the revised equity portion. I might say that this is the most difficult question anyone can give you under compound financial instrument. If somebody said that I'm going to give a very complex question on the compound, then it's just going to include issue costs. That's all. Then you go through this. It's not difficult. So the revised equity what portion. Now, after this, we now do our amortization. Amortize. Amortize the liability portion. Amortize the revised liability what? Liability portion. So after amortizing, what do you do? So in the amortization, in this amortization, remember to use the effective interest rate with the effect of issue cost. It's very important. Then the normal way, we now prepare our income statement and financial position what extract. Now go and the prepare the financial statement extract. Prepare the financial statement extract. So this is the process. So we are going to pick any question that we have there that is compound and has issue costs. We want to clear those questions. That is what we want to do tonight. So tonight we are bringing the curtains to an end on compound financial instruments. Friends, are we? Are you fine? Please, are you fine?
Yes, sir.
Okay.
Yes,
So
sir.
those who want to take a picture, I think you can take a picture. Please, can we move on? We now want to solve questions. Shall we?
Yes, sir.
Okay. So let's go and check. So question four. Question four, Yao Ejapon. Question four is Yao Ejapon. Yao Ejapon has issue costs. And then question five is Omega. Is Omega. They seem to have, I mean, they are very similar. Yes. So let's go through them. Each question will take us some time because of the way it is. I'll take my time as well. So let's take question four and then come and take question five. Okay. So let me go ahead and insert question four. Like I said, we want to try our best to solve at least 20 questions under financial instruments so that once there's question of financial instrument, you have to score up. We've done some on earnings per share, we've done 37, we've done 21. All will be uploaded on YouTube very soon. Okay, we are working on it assiduously. Okay, so let me go to the board and then insert. Tell your friends, this one is free. You have to take advantage. There is no class that you will attend that there will be time for the lecturer to solve 20 questions on compound. Any special, I mean, financial instrument, any special, we solved these 16 questions. So we are just taking advantage of these holidays. So they should join. It's free. Okay. So permission to insert. Did you read that or I should expand it again for you?
Sir, it's readable.
It's readable, okay. Okay. So if it's readable, let's read. Who will read for us? Whether male or female. Okay, let me read. Show how
Yeah,
they
that's
should
it.
be treated in the 2018 income statement and financial position. On 1st October 2017, Yao Ejapon issued 5 million. Now, the line where the short issued. So, because of the issued, we should know that we are in the books of who?
Issuer.
The issuer or the seller. 5 million loan notes that had a value of 1 CD per note. So, it means that the value to is 5 million. That's the face value. The issue costs were 3 pesos per note. So, what will be the issue cost? So let's first get the face value. So the face value equals to 5 million times what? Once I'll give her 5 million, right? Issue cost will be 5 million shares at what? 0.03. Don't go and write 0.30. 0.03. So how much are you going to get?
150,000. 150,000.
Are you sure?
Yes, please.
Friends, should we all accept it?
Yes, sir. That is 5 million times 0.03. 150,000.
150,000. Punch it well, oh. Okay, so 150,000. Each note holder will receive interest of 5% per note on 30th September of each year, starting on 30th September 2018. So interest payment, is that not it? Instead of them giving us the coupon rate, they give us the interest payment per share. That is how much? 5 pesos. So if they pay 5 million shares times what? 0.05. Do you agree with me? Hmm? Every year they pay interest of 250,000, right?
Yes, please.
But these figures, you need to get them right before you can start the treatment. The loan notes are repayable on 30th September 2022 at 1.2 per note. It means that it's payable at a premium. Do you see what I see? Do you see what I see? Because the nominal value is 1 CD, right?
Yes, sir.
But it is redeemable at 1.2, meaning it's redeemable at a premium. So that will be
Yes,
5
please.
million shares at what? 1.2 cedis per share. That will give us how much? About 6 million. Is that it? Is that it?
Yes, sir.
Okay.
Yeah, it's correct.
So that's the redemption value.
Mm.
The loan notes are repayable on 30th September 2022 at 1.2. Up to now, there's nothing in the question that shows that is compound. Did you get it? As an alternative to repayment, the loan note holder can elect to exchange their note for shares in the Japan. This statement tells us that, oh, okay, apart from the redemption that they are talking about at 1.2, they also have the option to convert into what? Into shares. And it is this additional statement that makes it what? Compound financial what? Instrument. Did you get it?
Yes, sir.
Had it not been
Yes,
this
sir.
additional statement, would have treated it as a financial liability and not compound. But because the holder has the right to either redeem at 1.2 or convert into equity shares, then we say it's compound. It's very important, Joe. Otherwise, if it's financial liability, you will end up saying it's compound. If it's compound, you will end up saying financial liability. I told you last time we met. On 1st October 2017, that's at the beginning of the year, the credit rating of your Japan was such that it would have had to offer investors non-convertible loan note at a rate of 9% per annum on any investment. So this 9% is the effective interest rate without the effect of the issue cost. The effective interest rate, with no issue cost effect, is what? 9%. The impact of issue cost would increase the effective interest rate on such loan note to 9.45. So effective interest rate with issue cost effect. That's how much? 9.45%. The financial year of your Japan ends on 30th September each year. Okay. So we are now ready to look at the question. Now, who can help us? What is the first step? What is the first thing to do in this question? After you have gotten your excerpts like this, what's the first thing to do? We go through step 1 by splitting between the liability and what? And equity portion. When you tried the questions that we solved, were you okay with the one with the annuity formula, or you were okay with the individual ones, the Kulu approach? I know you didn't try. This time, we are going to solve 20 questions. It's about 24 questions, correct? So as we go through, you should solve them, okay? And then be fine. Don't pile it up. So that when we meet like this, if you have any question from the previous session, you ask and you'll be fine. All right, so let's see. So step 1, we have the year. It's for how many years? Starting from September 2018, ends in September 2022. So let's count 2018, 19, 20, 21, 22. That's 5 years. So it's either you look at the interest for 5 years straight away, and then you look at the redemption value at the end of 5 years, or we go year by year. We should go year by year, right? Because of the Kolo people. So when they say it's 30 years, I'll see how you go about year by year. You must know the two approaches. It's important. So whatever we get here is the liability what? Liability portion. We now deduct from the face value to get the equity portion. So this is the face value. So we are saying that apart from this Kolo approach that we want to do, alternatively, we could have ascertained the liability and equity portion by calculating the liability portion as the interest will be for 5 years. So the interest will be 250,000. Then you open the annuity formula. 250,000 1 minus 1 plus 0.09 raised to the power -5 all over 0.09. Then you come to the redemption value. The redemption value will be paid at the end of the 5 years. So that will be 6 million multiply by 1 plus 0.09 raised upon negative what? 5. Whatever we get is the liability what?
Portion.
Portion. I was asking because you didn't go through, you can't even tell me. But those who went through, um, even the two formulas, which one are you okay with? Once the formula works too, you must learn how to punch because the examiner can say it's for 30 years. So what do? Can you do year 1 up to 30 like that? No, you have to use the formula. Did you get it?
Yes, sir.
Yes, sir.
You don't want to leave any stone untouched. So that is uh, face value is 5 million. Okay. Okay. So think some few people have registered for the class and they've started watching the video. So if you have registered, then we have not attended to you, just WhatsApp me and then we'll look at it. You'll get the lessons in advance to watch so that by the time we reopen school, you'll be fine. Okay, now let's move. Let's do our Kolo approach. So we have the cash flows. Under the cash flows, we have 250,000, 250,000. That's the interest. 250,000, 250,000. In the last year, they will pay the 6 million plus the 250,000. Is that not it? Is that not it? Then we discount at 9%. Hello?
We are
Hello?
following.
We,
Hi,
we
hi,
discount.
hi.
We discount at what? At 9%. So point for us, 1.09 is upon negative what? 0 point what?
1.917. 0.917, sorry.
0.917.
917.
And the next one, 0.
8, 4,
0.842.
The next one, 0.
seven, 7, 2.
The next one, 0. You just delete and you insert. You delete and you insert. You just be changing the powers. That's all.
7, 0,
2021,
708.
708. The next one,
6, 5, 0.
650. So present value. Let's multiply to get the present value.
229250. First one.
10 minutes. Two two nine
250.
250.
Yes, please.
The next one,
210,500.
210,500. The next one,
193,000.
193.00.
193,000.
Yes, please.
The next one,
177,000.
the next one,
40,62,500.
so when we add all,
4872250. What did you confirm?
But Christian said I should confirm, so confirm. So let's compare this with the face value of how much? 5 million. So the difference will be how much? One, 750. Am I correct?
Yes, please.
Okay. So now that we have this, that's all for step one. So you either use the first one or the second one. Now we now go and then share the issue cost in the ratio of the liability portion and equity portion and deduct. Did you get it? So in other words, step two, we are calculating the revised liability portion and equity portion. Revised liability and equity portion. So we have the liability portion. Then we have the equity what? Equity portion. So the first one that we split will give us the balance brought forward. The balance brought forward we had 48 what? 48
72250.
72250. Then this one was 127750. But we want to share issue costs of 150,000 and then deduct. How do we share? The liability component, the liability component of this issue costs will be 4,872,250 all over 5 million times 150,000. Did you get it? We are sharing it in the ratio of the liability and equity portion. Is that clear? Please, is that clear?
Yes,
Let me
sir.
get.
Then the equity portion will take 8 portion of 127. This is 750. 127,750 all over what? 4,872,250 times what? Sorry. The total ratio should be the 5 million, right?
5 million.
So 5 million. So the total ratio is 5 million. We are just sharing it the ratio of the liability and equity portion. So how much are we getting for the liability?
167.50.
One four to the nearest one, 146.
168.
I said it's 0.5.
0.5, yes, sir. 141. Yeah.
The 0.5, we're just going to worry that.
Okay.
Then the equity portion. 0.5, the one we approximate, one figure will be missing, one, that figure one will be missing. The next one,
That should be 3832.5.
so we deduct, sorry, this one should be here, 3832.5. So we deduct whatever we get is the revised figures that we should use for the amortization and the financial statement. Did you get it? Hmm? This is the revised figures. How much? How much? Did everybody feel what you did that? You should all point some or point some.
For the equity portion, 123917.5.
Point what?
50.
25.
Liability
Then the
is
liability portion
4726082.5.
was 726082.
82. Yes, please.
Is it 82 or 22?
82.
25. So we can now carry our liability portion at amortized. You see that because of the process you are supposed to go through, they didn't ask you to do the 5 years. They said you should do for only 20 what? 18. Did you get it? So
Yes, sir.
step 3, we do our step 3, we go through our amortization schedule. So amortization schedule. So what do we do? We have the year balance brought forward. We have the effective interest at 9.45%. So now we use the effective interest rate with the effect of the issue cost. Then we have the nominal interest as given. Then we have the balance at year end. So let's see. We are dealing with 2018. That is September 2018. So what's the balance at start? The revised figure for the liability. That will be 4726082.5. So 9.45% of the balance at start. How much? And that will give us how much?
Wait, on my part. This is 446614. That's correct.
That's correct.
Point
Okay.
eight. Okay, to the next.
So to the next one number.
It's
That's
15.
0.80.
Sorry.
Five.
615. Yeah.
Okay. Then the nominal interest. We know is 200 and what? 50,000, right? So we get the balance at the end of the year. How much do we get? The equity portion you gave, there's a problem with the figure. You said it's 123,917 point. It's plenty like that. The figure is wrong. Punch it again.
One,
Or
two, three. No, one, two.
is it just 917.5 or what?
Yes, please. 123
Okay.
117.5. Yeah.
So the amortization year end will be how much? Year end figure.
4922697.
492
Two
6.
four
You
nine
see,
two.
you don't know how to pronounce figures. It's 4 million. So you have to say 4. It means that when you say 4, the person should put comma. So
Oh, okay.
4, They mentioned that 3 digits. They mentioned the next three digits. So 4,
922 697
697.
point
So
five
we can now prepare our income statement and financial position.
point five.
Okay, 0.5. So your Japan statement of comprehensive income extracts. So now let's see. So for the year in the 30th September 2018. So profit or loss, we recognize finance cost. That's how much? 446,000. 446,000. 600 and what? 50. Okay. Then we have the statement of financial position. Statement of financial position. Okay. As at 30 September. Okay, so let's go. So we have equity. And equity, we have the equity option. Is that not it? That's the option to convert. The revised figure 12391 what 7. Is that not it?
Yeah.
Then we have non-current liability. Non-current liability. So that one we have loan notes. Loan notes. So what will be the loan notes? What will be the loan note?
Yeah. 4922.
Is what?
The 4922 697.
Four
Is it
nine two
two?
two 697. Okay, so that is that. So that is it. So set a question if it comes. It can even be 10 marks. You will understand why a small question like that is 10 marks. Friends, do you get it? Did you get it?
Yes,
Yeah.
sir.
Yes,
The question can be very small, but you can see that it entails a lot. It can give you 10 marks. 10 marks. The last time I saw one, no, it wasn't ICA somewhere, it was 15 marks. It was 15 marks. The question may be very short, but it has a lot of issues to deal with. So if you look at the question 5, it's very similar. It's just like this. Just that the effective interest rate is different and the other rate is different. Please, I want you to go and then you go through the question 5 this evening as your assignment. so that when we meet tomorrow evening, we'll solve it by way of revision to end the compound financial instrument. Then we can now start with the IFRS 9. Please do you get me? Please do you get me?
Yes, sir. Yes,
I'm
sir.
saying that there's question 5. Take it as an assignment and then solve right now, this evening, or this dawn. But by the time we meet tomorrow, you should have solved it. Then where you have issues, we can look at, because tomorrow, the first 30 minutes or so will be the last session for compound financial instrument. That is IAS 32. But these are the only questions we have under IAS 32. The rest is under IFRS 9. That is very broad. So that tomorrow we can start with the IFRS 9. I believe this time that you go and solve, but you won't do it like the weekend one. Yeah, so I mean, take it like the class ends at 9. Okay, see, what we are going to do plenty questions. So I am breaking it. I don't want us to do so much in a day. So today, the intention is to do compound financial instrument with issue cost. We are done. We don't want to add anything again. Go and solve the last question left. Tomorrow, we'll come and continue with it. We'll come and go through. If you are not able to solve, we look at the issues. Then we start with IFRS 9. So after tomorrow, there should be no issue with IAS 32 or compound financial instruments. Is that clear? Okay, let's go and take the pictures. If
Yes,
you
sir.
have any question, you can raise your hand and ask, please. If you have any question, please, those who place orders for the books, for the IFRS and the other books, your delivery will be made tomorrow morning. If you want to place your order too, it's not too late. You can place your order. They are packaging this evening, so they can package yours. Wherever you are, we can do the delivery for you. There's just not those in Liberia that we are facing some few challenges. In Ghana, everywhere, you can get the book. Okay, let's take the pictures. Those who joined late, we started from here, so we can start. Madam Wilfred. Wilfred should be a male, eh? Uh-huh. Honorable Wilfred.
Yes, please. So please, the IFRS, the book, that's the handbook. How much is it, please?
The I5 book is 230 cedis. That's the main book.
Okay, I'm talking about the pocket note, the
No,
pocket
we don't have the
note
pocket
that you
for the
talked about.
pocket. The pocket, we are yet to amend or revise that one.
Okay, so
So it's the main book.
the main one is okay.
Yeah.
Okay. And please, today I act on a platform where the video is being posted because I
Yes.
checked
We are
on
working
the
on it.
internet and it was
Yes.
3 years
We are
ago
working on it. We
videos that I was.
want to get all of them for you on YouTube. So we are working on it for you to get it. So that
Okay. Okay.
at first I think we thought Telegram was going to give us the option where when you download, you don't need data to watch it again. But some students said that that is not the case. They were, if you want to watch on Telegram, you still need the data. Otherwise, you may have to download, saving and all those things. So want to upload on YouTube. YouTube there. When you go and watch, you can just save it offline. So anytime, even if you don't have data, once you have
Yes.
downloaded it, you can still go and watch. Yes. So that's what we are trying to work on.
Okay.
You get it. Yeah.
Okay, sir. Thank you very much.
Okay. So please, we are moving to the second page, next page. So the class registration too is ongoing. Register early and start watching the pre-recorded videos for all the topics ahead of the class, so that you will be far, far, far ahead of the class. The class will start on the 6th of December. We are done marking your papers by ending of this month. We'll bring your papers. Okay. Heavenly Father, we thank you so much for learning with us. We pray that the little we have learned today, you bless it for us so that that day we can be able to reproduce and pass our exam. And at the end, glory and adoration shall be given unto your name. This and many more we ask in the name of the Father and of the Son and of the Holy Spirit. Amen. Tomorrow, no
Amen.
one should miss
Amen.
it because
Amen.